Stockwatch is brought to you by Merchant Waste. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant Waste. Finance, invest, insure.
You're watching Stockwatch this week. I'm Ntawleng Lechela, and joining me to unpack your stock-related questions today via Zoom is Chantal Marx from FNB Wealth and Investments and Cobus Potgieter from Southern Cross Capital. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via Zoom on 41392 or on X at Business Day TV using the hashtag Stockwatch. Chantal, Cobus, thanks so much for your time this afternoon. Maybe let's start with, the broader moves. All eyes are on the delayed U.S. inflation print. Is it much of a market-moving print, considering that many don't expect it to deter the Fed from lowering rates next week, Cobus?
No. I think the market's become a little bit complacent around this because, I see a lot of analysts sort of saying that regardless of what the print is, they'll cut next week and they'll cut again in December. Of course, they could reverse course if inflation rears its head. But I think expectations are broadly that even if inflation is more sticky than anticipated, and we are anticipating a slight uptick, we are likely to see a cut next week. But at the same time, I'm loath to say that with so much certainty, given that the amount of data we've been getting through the shutdown has been much diminished. So there is a little bit of risk to the downside, but for the moment, the market doesn't seem to think so.
Yeah, and economics aside, Chantal, investors also looking ahead to the meeting between Presidents Trump and Xi taking place next week. Is that something on your radar? I mean, considering the amount of back and forth we've seen over the past week or so, could we be getting closer to a resolution, considering that it's also the first face-to-face meeting since Trump has taken office the second time around?
Yeah, I don't think we'll get to a resolution, but we could see kind of all of the fears around the recent escalation fading. And we've already started seeing evidence of that just through the announcement of that meeting taking place. From what we've seen is US President Donald Trump speaks a big game on Truth Social, and he makes very bold announcements. But generally, as soon as he's actually in the room, let's just exclude the White House South Africa meeting.
It reminds me of taco trade.
Yeah, it becomes, I think he wants to impress these leaders as well.
Yeah.
And he wants to have a friendly relationship. I think in person, the sting is removed to a certain extent. I think a lot of work has already been done in the background to get to a broader trade agreement, or at least a workable solution. So hopefully everything that happened in the background by trade officials have not been completely derailed by tweets and social media posts.
All right, let's get into the questions. One on the luxury side of life, Kering, asking whether its decision to sell its beauty business is a smart move, considering that in the past it's been trying to reduce its reliance on Gucci. Cobus?
I don't have a strong view on this either way. To be honest, it's one of those things where I'm a consumer of the news.
Okay.
Certainly not an expert.
All right, let's pause
in the division.
Yeah, chat to the girl.
Yes, let's pass it on to Chantal.
Please.
So I think it's a very smart move for them, because they really need to be focused on that Gucci turnaround right now. I think Gucci has also been a bit of a victim of loud luxury taking a back seat in terms of recent fashion cycles relative to quiet luxury. Gucci is loud. I mean, you see it. It's on the shirt. It's on the shoe. It's on the bag. It's everywhere. And that just doesn't work in the current fashion cycle. But they need to think about the future from a Gucci perspective and where they want to go with that brand. And that is where most of their attention has to be. They've also done very, very well on the eyewear and accessory side. And I think that they need to continue with that focus. Beauty is an interesting differentiator, but it's not a core competency for Kering or their management team. Partnering with L'Oreal on this, I think, is very clever because it is a core competency for L'Oreal.
Yeah.
They'll continue to get royalties from this deal as well. So if L'Oreal does well with the beauty business for Kering or the Kering beauty business, they'll continue to benefit in years ahead.
All right, then from luxury/beauty to tech then, Cobus. We were talking off air and, you've been burnt when it comes to Intel. And we are seeing a turnaround taking place. We are seeing investors quite excited about those numbers that were out yesterday. Just your analysis on that counter and the turnaround we are seeing there.
Cobus is suffering shots today. Yes, so we entered Intel as sort of a turnaround play, ironically at the kind of level it is trading at today, after essentially a failure in the rollout of its foundry business, and off the back of that, I guess it's become a bit of a government intervention play. Given that the US has demonstrated a willingness to protect its strategic assets, and the semiconductor sector has been largely identified as strategic in nature, trying to offshore some of those operations out of Taiwan and trying to get some indigenous manufacturing going so far as to effectively bullying TSMC into doing so-called IP transfers and getting the likes of not only the US government itself, but NVIDIA to invest into Intel. Now, the previous quarter, we saw them post a headline loss, and that has been forecasted now in this quarterly report to swing to profitability. So it looks like it's possible that Intel is finally turning the corner, and finally the outcome of foundry production is also looking more positive out of the expanded operations in Phoenix. So one of the best performing tech stocks of the year, if you manage to pick the bottom there.
I mean, look at what having Trump on your side can do, hey? All right, Chantal, let's get your take on it. Is it too soon to bet on that turnaround strategy? Are there better counters in that sector? Or would you be dipping your fingers there?
Yeah, so I mean, if I'm thinking about the chip manufacturing story, so investing in foundries, I'd still back TSMC. Yeah, I just think that the gap between them and the rest are actually quite substantial. And remember, it's not only the technology IP; it's human capital, it's the actual foundry footprint. It is exceptionally expensive to build a foundry.
Yeah.
Very, very expensive. And TSMC has invested a lot over the years. They've got a nice global footprint. So, yeah, that share also doesn't look particularly expensive. Intel doesn't look expensive relative to where it's traded at in the past.
Yeah.
But I think the risk, the execution risk is still quite substantial there. So I would prefer TSMC in that space.
And, talking about a riskier bet, a riskier counter, that being Sasol, a fave here on Stockwatch. Yesterday we saw it really rallying on the back of course, the higher oil price, but also an upbeat update. Cobus, what do you make of that update? There's a question here around whether our analysts are more confident on Sasol after the upbeat update we got yesterday.
Yes, so upbeat in terms of the execution, that's fair. But ultimately, I wouldn't want to start here. Always scary when you're in a foreign city and when you ask for direction, somebody tells you don't start from here. And that's essentially the situation Sasol found themselves in. On the flip side of the positive sentiment in terms of operational execution, we've got further pressure on the chemical prices, which of course is the other large division outside of oil, and a lot of energy specifically, and a lot of the positive sentiment was around a rebound in the price of Brent, thanks to factors outside of Sasol's control. So I remain negative on the business. Impossible to short because it's such a marginal producer now that a relatively small uptick in the price of crude or even those chemical outputs can lead to an enormous rally in the share. But over the long term, given that they are such a high cost producer, and the risk of execution is high, it's not one I like. I continue to dislike and avoid it as far as I can.
And how do you rate Sasol at the moment, Chantal? Seems to be more clarity from management, more certainty from management, but we are still, waiting for real implementation when it comes to that strategy, of course. Is it one to hold for the long term, or are we still a bit cautious there?
Yeah, so while Cobus was speaking, I was actually thinking that Sasol really has become a pretty solid trading stock. I don't think it's a stock that you can sleep comfortably at night knowing that it's in your portfolio, because it's so marginal and because the swings are so massive. I mean, yesterday's swing was just insane based on a okay production report that's kind of meeting very conservative capital markets day estimates. And then a bit of a spike in the oil price, but 17% up in one day. I mean, that is pretty substantial. So I kind of view it as a trading stock now. With this company, I'll be watching the technicals closely. I'll be looking at news flow. I'll be looking at important kind of announcement dates, and then kind of trading around that. I would not want it in my portfolio longer term, because if it can go up 17% in one day, it can go down 70% in one day as well.
A trading stock. And yeah. I mean, quite a few analysts on the show have picked Sasol based off being just a trading stock and not one to hold for the long term. All right, let's move over to the retail industry, pharmacy chain industry with Dis-Chem and Clicks. A viewer asking, why are we seeing Dis-Chem on the back foot when it comes to the share price and Clicks flying away? Chantal, I'll give that one to you.
Yeah, so I think it's about history and track record. So Clicks has a very long history of being a listed company in South Africa. It's very much a favored retail exposure, especially to foreign investors. They really like the stock as well. And their execution has been almost perfect over the last 2 decades. Dis-Chem has had a bit of a more choppy start. So firstly, it listed a lot later. It's only a few years ago that Dis-Chem listed. At first, investors were a little bit skeptical around Dis-Chem and a massive kind of family involvement from the Salzmans. They've since exited, but it's also been choppy from a results perspective. It hasn't been smooth sailing for Dis-Chem. I do like both of these companies. I would like to hold them both for different reasons. I think it's a great sector to be exposed to in the South African context. But yeah, I hope this explains why you see that discrepancy.
Cobus, let's get your views around Clicks, right? Out with results earlier this week, looking at earnings, double-digit growth in profits, private label brands, as well as those generic medicines giving it a boost. A solid showing from the company.
Yes. Look, relative to Dis-Chem, as Chantal alluded to, it is the high quality checker. The premium it trades at isn't that substantial, and it does fluctuate quite a lot over time. Part of that perhaps has to do with lesser liquidity in Dis-Chem. So a big seller can often move that around quite a bit, and they are highly correlated. So as an equity pair, it's a very reliable sort of trade. Going long Clicks and short Dis-Chem when the Clicks gets relatively cheap, and the inverse as well, even though of course we would prefer the long Clicks side of that trade. But ultimately, these businesses attract very attractive multiples, very high multiples for a reason. They are high quality. They are, classic SA Inc. stocks geared for growth, and of course, highly defensive and predictable as well. So I like both. At current valuations, I do still prefer Clicks, but I believe I'll hold Dis-Chem as well.
And Chantal, maybe we can take a look at some of the big retailers' pharmacy-like offerings. Just recently, Spar deepening its exposure into that market with the acquisition of Aptacor. We know ShopRite has MediRite also in that space.
Yeah, so I mean, pharmacy has really been a growth area in South Africa generally. I think the corporatization of pharmacy has also been an interesting trend. I mean, even if you look in the Dis-Chem stable, they've taken over these, well, they haven't effectively taken over, but the local choice model, that's kind of like a franchise model, has really taken over the independent pharmacy footprint that we were used to 20, 25 years ago. So I think that the growth there is still there. I think that the pharmacy is complementary within that grocery space. I don't think that market is saturated yet, but I think that we need to monitor that carefully and make sure that we don't get a scenario where pharmacy is completely oversaturated and these chains continue to be pushed out. I will say what makes Clicks and Dis-Chem slightly different to these pharmacies is that I think the offering is a lot more concentrated. You know what you are going to get when you go into a Dis-Chem or a Clicks. You go there for a specific reason. You'll get everything you want in that specific box format. Whereas in a grocery chain, it's big, right? There's a lot going on. So perhaps when you're looking for something like healthcare and beauty and pharmacy specific, you'll probably still prefer to pop into a Clicks or a Dis-Chem.
And the likes of a Clicks and a Dis-Chem is always nearby. I mean, you look at the store expansion plans, and I promise you walk for 2-3 minutes and you'll definitely see either a Clicks or a Dis-Chem in your neighborhood. I want us to move over to the restaurant market where famous brands place. A question here, Cobus. The share has been stuck in a band range from 2021. What's your view and any catalyst at this point to catapult it?
Better execution. The last set of results are pretty disappointing. They are scaling back the overseas adventure, and they have this second tier of brands. I think they call them speciality, that has been essentially losing money. Top tier brands still performing well, franchise businesses. So honestly, it's become a little bit disjointed. And on top of that, there continues to be sort of governance concerns. The market doesn't like the founders, the leadership within famous brands. And I guess a catalyst would be a more aggressive overhaul of both the portfolio and the management team to ultimately unlock more upside. But until then, I think it'll remain a relatively poorly rated SA stock.
All right, let's get your thoughts around famous brands, Chantal. I mean, just as, a company and the value proposition it offers, I think Darren Hill has mentioned that your retailers, your grocers, have also been stealing market share with the ready-to-eat meals in stores as well.
Yeah, I have 4 words. Where is the chicken? I think that also is potentially an issue for them. So pizza has been a massive growth category, and over the last few years, they've managed to really benefit from that. We saw the same thing for Spur as well. But where is the chicken? You have a big gap in the portfolio offering without a proper chicken franchise in there. I believe they are looking for a chicken franchise. They've tried it before. And it hasn't really worked out. But I think that could be a potential catalyst for them. For now, though, I prefer actually Spur over famous brands. I think that they've really nailed the family dining market with Spur and Panarottis. The loyalty program is absolutely fantastic, and they've made their restaurants more of a destination. Quick service is great, but I think that your growth runway is quite limited, and you end up becoming very dependent on economic growth in order to make a case for more restaurants being rolled out. And I think, in the absence of economic growth, the issues that Cobus has mentioned and the absence of chicken makes me not that excited about Famous Brands.
All right, from the dining market to food producers, a question here on the Premier RFG deal. Is this takeover a great business case on how to use expensive script to generate shareholder value, Chantal?
Yes. But, I mean, yes, in theory, because we don't know how the integration is going to progress.
Yeah.
Acquisitions are almost always, particularly when they're quite big in size, almost always destroy shareholder value. But you've got a lower likelihood of doing that when you've got a script takeover and you are the more expensive business and you're taking over a cheaper business. So your hurdle rates for making it success is a lot lower. But execution risk is substantial when you're doing something like this. So I'm a little bit on the cautious side. Very happy for RFG and a very happy RFG shareholder because I think that company has been struggling for a catalyst to get out of a perpetually low kind of market rating for quite some time. And I do like the idea of the two together, really proper scale. They don't really overlap too much, so perhaps that'll make integration a bit easier. But yeah, it's I'm skeptical because I'm always skeptical about big acquisitions.
And what about you, Cobus? Chantal there mentions those execution risks. Markets, however, seem to be liking that potential merger.
So I fully agree on execution risk and empire building by management teams. Building bigger businesses for the sake of getting a bigger salary bill going. But in this particular instance, given that the more expensive entity is acquiring the cheaper one with scrip, with shares, even if we didn't have a cent of cost savings or synergies, it is value accretive for the Premier shareholders from day one. And of course, for the Rhodes Food shareholders, or RFG, they get the multiple of the higher rated business. So this is one of those pretty rare win-win situations that really does add value to both sets of shareholders. No matter how you dice it, they would have to, do the opposite of good integration from here to actually destroy value. And on top of that, I actually do back them to bed it down nicely. It's a great brand of portfolios, gives them a little bit more presence, a tiny bit more liquidity. So it's a pretty good outcome. And acquiring via a share issuance is it just makes sense if it is genuinely value accretive from day one.
Let's move over to stock picks. I will stick with you, Cobus. Where are you seeing opportunity at the moment?
So they were in the news this morning for an acquisition in Uganda, ABSA. Haven't called it in a while, but it does feel like we've been sort of hitting the drums for the banks being cheap. And the bonds have rallied, so the cost of capital in the country overall is coming down. The universe seems to be a little bit more bullish on South Africa, relatively speaking, at least overall. And these banking stocks, frankly, have languished relative to those expectations. So we see them as very high quality, well-capitalized businesses. In ABSA, you get, it's at an historically cheap valuation. It's posting better ROEs than it has in a long time. The African exposure is quite attractive as well, and those markets continue to benefit from the uptick in the commodity prices we've seen. We've seen Ghana as an example, the largest ex-South African market, making a complete about turn. The devaluation of the currency essentially reversing and the buildup of reserves taking place, mostly off the back of a strong gold price and a strong coffee and cocoa price. So all of this just adds up to a really attractive proposition. And it's our favorite pick in the SA banking sector.
All right, Cobus betting on SA Inc. with banks. What about you, Chantal?
I love SA Inc., but I'm actually not going to choose an SA stock today.
Okay.
So in the last 2 weeks, probably prior to Monday, there's been a lot of debate around the debasement trade. So, I mean, even before that, Valuations in the US have been very expensive, and when we're looking for offshore exposure, it's very difficult to find growth outside of the US. But in Europe, there's a company called Galderma.
Okay.
They do Botox injections and fillers, and they also have a pretty sizable skincare business. If you've been to a dermatologist, you would have been given Cetaphil at some point in your life. That is one of their brands. And they've also started marketing a new product called Nembulio that works for eczema. And it works very well for eczema. And it's been groundbreaking. In its first year of launch, sales have topped even the most bullish estimates by analysts and by management. The stock is not cheap. It's a stock that trades on a 40 times forward PE, but it's growing at 40% over the next 5 years off of Nembulio and continued broader market adoption of aesthetics, as well as firm growth in dermatological skincare. So a really exciting prospect if you're looking for growth outside of the US and outside of tech.
All right, let's leave it there. Chantal, Cobus, thanks so much for joining me this afternoon. That was Cobus Potgieter from Southern Cross Capital and Chantal Marx from FNB Wealth and Investments. Do remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on a Tuesday and Thursday, while Stockwatch this week is live at 12:30 p.m. on Fridays. Keep that in mind and keep those questions coming through. For now, that's all from Stockwatch this week, but do stay tuned for lots more coming up right here on Business Day TV.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.